Well, so I think that it's priced so that even high expectations aren't high enough. That's how a lot of these things work. And so when selling happens on good news, that just kind of shows exhaustion in the market. Um, right now there's a lot of global capital stuffed into U.S. equity markets. It's kind of been like the only investable spot for like 10, 15 years. Um, and this historically does go through some cycles. Again, there's not a huge sample size because the modern era of finance is only so long. But when you look at, for example, developed versus emerging markets, they tend to go with these big dollar cycles, and that also kind of aligns with the commodity capex cycles, which is where you get periods of disinflation or reinflation. And so I do think that there's a meaningful risk going forward that global capital, or at least around the margins, starts pulling out of U.S. equities and starts going back elsewhere where things are cheaper, and you can start kind of a flywheel. So, generally speaking, the way that emerging markets work, and China and India are a little bit different, but many emerging markets, they have a lot of dollar-denominated debt. Um, and it's mostly not owed to the U.S. It's mostly owed to other countries. It's owed to European lenders. It's owed to Japanese lenders. It's owed to Chinese lenders. It's all this, but it's denominated in dollars. Um, and when the dollar strengthens because of a hawkish Fed or other multiple variables go into that. When the dollar strengthens, it squeezes all those emerging markets because their liabilities are hardening relative to their cash flows and their asset prices, and
Mhm.
that's just it's a very poor liquidity environment for them. And then that kind of starts a flywheel because then capital doesn't want to be there where the whole place is doing badly. So they take money out and then they put it into the US, which further strengthens the dollar and further exacerbates that issue.
With US equities now trading at an astounding 55 times earnings, the risk of global capital pulling out of the US is more real than ever. Lyn Alden points to a potential major shift, where money could flow into cheaper emerging markets like Southeast Asia and Latin America. This rotation could trigger a financial flywheel, fueled by a weakening dollar and surging economic growth in these regions, creating incredible opportunities for those ready to pivot. This could be one of the most significant capital shifts we've seen in decades, impacting everything from commodities to global market dynamics.
But it eventually gets to a point where, like, it kind of breaks all the countries that are not strong enough to, they don't have enough reserves. They have too much dollar denominated debt. Other ones hold in there. And so eventually that kind of exhausts itself. The US economy itself starts to slow down. The US does some sort of dovish pivot, and then you can actually have that flywheel go in the other direction, where finally the dollar's weakening a little bit, which gives them signs of life. Their liabilities are softening relative
Mhm.
to their cash flows, and then investors can see that and say, look, there's signs of life. Maybe I want to take the marginal dollar out of Costco that's trading at 55 times earnings, and I wanted to be there because it's super safe. Maybe I can take the marginal dollar out and put it into Southeast Asia or into Latin America. And then that, takes a little pressure off the dollar, strengthens those markets, and that furthers the flywheel. So capital flows become the fundamentals, which then encourage more capital flows. And the risk here is that it's very easy to be early. There's been a lot of people calling for asset rotations for a very long time. Um, and myself included at times, because there's certain catalysts where there's a window that's open for it, and then you either see if it's going to happen, and if it doesn't, you move on to it not happening, right? So
Mhm.
the last time there was a serious catalyst was 2019. That was the last time the Fed began a rate cutting cycle. That was before the pandemic. The U.S. economy was slowing. They started cutting interest rates. By the end of the year, they went back to balance sheet increases. And this started to look like a potential rotation because there was so much capital stuffed into the U.S. and they were finally turning dovish. But then, of course, that all got derailed by the pandemic because many emerging markets did not hold up as well as the United States and other countries did. Um, and so this is kind of the first serious catalyst in 5 years here in 2024. And that doesn't mean that it's guaranteed to happen this time. There's certainly things that could derail it. But this is like a very narrow window where there's a meaningful chance that a rotation could occur. So the last one was 2019. The one before that would have been the great financial crisis cutting cycle, but that was at the end of an emerging market cycle. Capital's already in emerging markets at that time. The dollar was weak going into the global financial crisis. And then the one before that was the post-dot-com cutting cycle.
Mhm.
And that was indeed the last time there was a rotation from overvalued, overinvested US equities into emerging markets. So not a huge sample size, but in this kind of past 25-year period, this is a pretty significant window, I would say. Yeah, they all tend to rotate together at different speeds. So generally, if you have decades where emerging markets doing well, it's generally because the dollar is weakened. That's generally really good for gold, and it's generally really good for commodities because they're globally largely priced in dollars. Now that's changing a little bit around the margins due to greater BRICS integration of
Sure.
payments. But most commodities are still priced in dollars, and so both the denominator falling and some of these, like, the marginal commodity demand is in emerging markets. United States and Europe and
Mm.
Japan are not greatly increasing their commodity demands. It's the emerging world that is. And so when kind of the dollars relieved from them a little bit, they tend to have more of an economic boom, which tends to be pretty commodity intensive. So if an American gets marginally richer, they generally don't consume a lot more commodities. They're already kind of consuming a lot, whereas the marginal emerging market person, they're consuming a much lower baseline, and so they meaningfully do tend to increase
Yeah.
their commodity consumption when they have some sort of when the economy is going well. And if you look at like the dollar denominated GDP of places like Brazil or much of Southeast Asia outside of India, a lot of them have like been sideways in dollar denominated GDP for years. That tends to happen when you get these strong dollar environments.
Hmm.
And so they've been kind of flatlining for a while. And if they do get that cycle reverse, you could see meaningful commodity demand out of them. Of course, the other big component to watch is the capex cycle. So, the shale growth really kind of destabilized global oil markets, but that's not part of global oil markets. That's now kind of integrated into the supply demand characteristic. We generally see wells depleting faster. A lot of the drilled but uncompleted wells have already been used up. We see kind of just like flatlining U.S. oil. I think that's probably a trend that has some legs to it. OPEC still has spare capacity, but it's not that hard to kind of grow into that if you do get a pretty significant, if this rotation occurs to any meaningful degree over a 3 to 5 year period. I would expect to be pretty bullish for broad commodities. So I generally am in that view that a lot of those assets together are likely to do fairly well over this next upcoming cycle. So there's a couple different areas. One is if you look at Latin American equities. So let's say the ILF ETF. And if you do a ratio chart, total returns, ILF versus the S&P 500, it's actually been like it bottomed like a few years ago. And it started to reverse, and then it kind of pulled back in the U.S. favor again, but it hasn't hit a lower low yet, meaning that this rotation's kind of been in place for a few years, where for many years the U.S. was outperforming Latin American equities, and now that's kind of not happening anymore. It's not really going back in the direction yet, but at least it's not continuing. And so I do think that we're probably into that rotation phase now. If you look at the S&P 500 versus broad emerging markets, that still is that's not started to reverse yet, and that's largely because Chinese equities have done so poorly. And
Okay.
some of that's a policy choice on their end. They can kind of end that like whenever they want to. So I think that the timing question will partially come down to, when you look at that broad index, is what is China going to do? When are they going to when are they going to decide to change their policy mix? I think we're already seeing signs of it, but it's still kind of early. I think that the rotation might have already started in Latin American equities. Potentially just ex-China emerging markets in general. And I think that the gold breakout obviously has already been interesting. So I think we're kind of at the early stage of this rotation happening. When you look at the post-dot-com bubble cutting, we had U.S. like economic softness in 2001. Emerging markets were kind of basing relative to the S&P 500 for 2002, 2003, and then they started to really take off until 2007 or so. That kind of ratio is very much in their favor. So I think that this is probably a multi-year story that'll probably take more patience to play out. But at least on some of those markets, I'd say it already has begun. Gold's broken out. Latin American equities are not really hitting lower low when you look at a total return basis. And so I would kind of monitor those trends to see if they continue.
That wraps up today's video. To quickly recap, we've covered some crucial insights from Lyn Alden, about the growing risk of capital leaving the US equity markets, the potential for a financial flywheel in emerging markets, and how a weakening dollar could spark a new wave of growth in regions like Southeast Asia and Latin America. These shifts could play a major role in reshaping global markets and future investment opportunities. Thanks so much for watching. If you found this content helpful, make sure to give it a thumbs up, share your thoughts and questions in the comments below.